Your credit score plays a significant role in your financial life. It can affect your ability to get a loan, rent an apartment, buy a home, or even secure a job in some cases. But what many Canadians don't fully understand is how their credit score is calculated, what models are used, and how lenders interpret these scores. In Canada, credit scoring is a highly sophisticated system developed to help lenders assess your creditworthiness. Essentially, your likelihood of repaying borrowed money. Two primary credit bureaus dominate the Canadian market: Equifax and TransUnion. These bureaus use different models and formulas, which means that your credit score may vary slightly depending on which one is used. Understanding credit scoring models is crucial, not just so you can improve your credit, but so you can take control of your financial future. In this video, we're breaking down everything you need to know about credit scoring models in Canada: how they work, what factors affect them, how they're different from US models, and what you can do to maintain or improve your score. 1. What is a credit score? A credit score is a 3-digit number that represents your credit risk, or how likely you are to pay back money you borrow. In Canada, credit scores typically range from 300 to 900. The higher your score, the more likely you are to be approved for credit with favorable terms, such as low interest rates and higher limits. 2. Canada has two primary credit reporting agencies: Equifax Canada and TransUnion Canada. Both of these agencies collect credit information on individuals and businesses. They receive data from lenders, credit card issuers, utility companies, and other creditors to maintain your credit report. Each bureau uses proprietary scoring models, so your score can differ depending on which bureau is used. 3. The key credit scoring models in Canada. In Canada, credit scoring models are typically customized by each bureau, but they are based on core principles developed by companies like FICO, Fair Isaac Corporation, and VantageScore. 4. What factors affect your credit score in Canada? While exact formulas are proprietary, most credit scoring models in Canada are based on the following 5 major factors: payment history, credit utilization, and length of credit history. The longer your accounts have been open and in good standing, the better. A lengthy credit history shows consistency and stability. 5. Soft inquiries versus hard inquiries. Understanding the difference between these two types of credit checks is crucial. Soft inquiry. These happen when you check your own credit or when a company checks your report for pre-approval. They don't impact your score. Hard inquiry. These occur when you apply for new credit, like a loan, mortgage, or credit card. Too many hard inquiries in a short time frame can reduce your score. 6. Differences between Canadian and US credit models. Many Canadians assume that credit scoring models work the same as in the US, but there are a few differences. In the US, FICO and VantageScore are more commonly used. In Canada, Equifax and TransUnion create custom models for Canadian lenders. 7. How often do scores change? Credit scores are dynamic. They can change monthly or even more frequently depending on your financial activity. Here's what can cause changes. Because of this, regularly checking your credit score can help you stay informed and take corrective action when needed. 8. How to improve your credit score in Canada. Improving your credit score is all about good habits and consistency. Here are some strategies that work. Pay your bills on time, every time. Reduce your balances, especially on revolving credit like credit cards. Keep old accounts open, even if you don't use them often. Limit new credit applications to only when necessary. Diversify your credit portfolio over time with different types of credit. Review your credit report regularly and dispute any inaccuracies. Even small improvements can make a big difference when applying for loans or negotiating interest rates. 9. How to check your credit score in Canada. Canadians have several ways to check their credit score. Equifax Canada offers a free credit report once per year, or you can subscribe for ongoing access. TransUnion Canada also provides a free annual report and paid monitoring options. Third-party apps like Borrowell, Credit Karma, and Mogo provide free credit scores, usually based on Equifax or TransUnion data. Checking your own credit score through these services does not affect your credit. It's considered a soft inquiry. 10. How lenders use credit scores. Lenders in Canada don't just rely on your credit score alone. While it's a critical factor, they may also consider your income and employment history, your debt-to-income ratio, and the type of credit you're applying for. So while a high score improves your chances of approval, other financial behaviors and data still matter. In conclusion, credit scoring models in Canada are complex, but they're not a mystery. Understanding how these models work gives you the tools to make smart financial decisions and shape a more secure financial future. Whether you're planning to buy a home, take out a business loan, or simply want to be seen as a low-risk borrower, maintaining a strong credit score is a vital part of the process.